Welcome to the deep dive. Today we're really zeroing in on AppLovin, specifically their first quarter 2025 financial results.
Right. We've got the official update, the press release, and some interesting analysis from Smart Karma, too.
Exactly. So our goal for you in this deep dive is, well, to get past just the raw numbers. We want to understand the real story behind AppLovin's performance and, what the analysts are thinking.
And there's a bit of a head-scratcher right away, isn't there? AppLovin put up some, frankly, very strong numbers.
It's really strong.
But the stock actually dipped a bit after hours. So I think the key question for us today is, what are the big takeaways from these Q1 results? And maybe why that slightly weird market reaction?
Okay, good plan. Let's start high level then. Q1 2025 versus Q1 2024. What jumps out first?
Well, just the overall growth, you have to say. Revenue was up 40%. That's $1.48 billion compared to about $1.06 billion last year. Big number.
40% is definitely significant. I thought the net income figure was even more, well, startling.
Oh, absolutely. Net income soared, up 144%. So that's $576 million versus, what was it, $236 million?
Wow.
Yeah. And that pushed their net margin up quite a bit, too, from 22% to 39%.
Okay, so not just bringing in more money, but keeping a much bigger slice of it, that sounds like serious improvement in efficiency.
That's exactly it. It suggests they're getting much better at turning that top-line revenue into bottom-line profit.
Feels like things are really clicking for them. Was it just net income, or did other profitability metrics look good too? I saw adjusted EBITDA mentioned. Maybe a quick refresher on what that tells us.
Sure, yeah. Adjusted EBITDA, it's basically a way to look at the core operating profitability. It strips out interest, taxes, depreciation, amortization, things that aren't part of the day-to-day operations.
Right, so the pure business performance.
Exactly. And for AppLovin, that was also way up, 83% increase to $1.01 billion. The margin there jumped, too, from 52% last year to 68% this quarter.
68% margin on adjusted EBITDA. That's pretty huge.
It is. It really reinforces that point about operational efficiency. And they're generating a lot of cash, too. Net cash from operations was $832 million. And free cash flow, $826 million.
Okay, $826 million in free cash flow. That gives them options, doesn't it? What can they do with that kind of cash?
Well, yeah, lots of options. Reinvest in the business, obviously. Maybe look at acquisitions, pay down debt, or, like they've been doing, return capital to shareholders, maybe more share buybacks.
We'll definitely come back to those buybacks. But first, let's break down the business segments. Advertising is the big one, right? That's the main growth driver.
Oh, for sure. Advertising performance was really impressive. Revenue there grew 71%.
71.
Yeah, to $1.16 billion. And what's interesting is how they did it. Net revenue per installation, so how much they make per install, that jumped 49%.
Okay.
And the number of actual installations also increased by about 22%.
So they're getting more installs, and each install is making them significantly more money. That sounds like a winning formula.
It really is. It suggests their platform, their tech, is getting much better at finding valuable users.
Yeah. And how did that flow through to the profit for advertising?
Same story, really. Advertising adjusted EBITDA was up 92%, hitting $943 million. And the margin for advertising alone, 81%.
81% margin. Wow. Up from 73% last year.
Exactly. That probably points to the power of their AI platform, AXON. It's getting more efficient, more scalable. It's like a flywheel effect kicking in.
Okay, advertising, clearly booming, super profitable. Now, the other side, the apps segment, that's a bit different.
Yeah, a bit of a different story there. Apps revenue actually went down by 14% to $325 million. But interestingly, the profitability, the apps adjusted EBITDA, it actually increased by 9% to about $62 million.
Huh. Less revenue, but more profit. How does that work?
Well, the margin improved, went from 15% to 19%, so they operated that segment more profitably, even with less money coming in the door.
What drove that? Any specific metrics?
Yeah, they mentioned a couple of things. Monthly active payers, or MAPs, that number actually decreased, down to 1.5 million from 1.8 million year over year.
Okay, fewer paying users.
The average revenue per monthly active payer, ARPMAP, that went up to $52 from $48.
Ah, okay. So fewer payers, but the ones who are paying are spending more on average, maybe focusing on higher value users.
That seems likely. Maybe better targeting, focusing on the core players, perhaps. It's an interesting trade-off.
It is. Okay, that clarifies the app's segment dynamics. Let's glance at the balance sheet. Any big shifts in their overall financial position between the end of last year and March 31st?
A few things to note. Cash and cash equivalents went down a bit to $551 million from $741 million.
Right.
But accounts receivable went up to nearly $1.6 billion from $1.4 billion. That's kind of expected when your advertising business is growing fast, more sales on credit.
Makes sense. What about debt?
Well, they took on some short-term debt, $200 million where there was zero before. Total assets dipped slightly, total liabilities went up.
That increase in short-term debt, is that something to worry about?
Not necessarily worry, but, keep an eye on. Could be for working capital, maybe tied to strategic moves. We want to see how that plays out. Oh, and one other thing, fewer shares outstanding.
Right. The buybacks you mentioned earlier.
Exactly. They bought back or withheld 3.4 million shares in Q1. Cost them $1.2 billion.
Yeah. $1.2 billion on share buybacks. That's a pretty strong signal from the company, isn't it, that they think their stock is a good deal?
It certainly suggests they believe it's undervalued, yes. It's a significant return of capital to shareholders, basically the company investing in itself.
And speaking of strategic moves, there was some really big news related to the app's business itself, right? Separate from the Q1 results, but announced around the same time.
That's right, yeah. On May 7th, they announced they're selling their mobile gaming business.
Selling it off. To who?
To a company called Triple Dot Studios. The deal is $400 million in cash. Well, $150 million up front. $250 million as a promissory note. Plus, they're getting about a 20% stake in Triple Dot.
Interesting. So, mostly cash, but also keeping a piece of the action. When does that happen?
Expected to close sometime this quarter, Q2 2025.
Okay, so that's a huge strategic shift. Getting out of the first-party apps business to focus purely on the advertising platform, essentially.
That seems to be the clear message, yes.
And does their guidance for Q2 reflect that?
It does. They only gave guidance for the advertising segment for Q2, which makes sense given the pending sale.
And what are they expecting for advertising?
They're forecasting revenue between $1.195 billion and $1.215 billion, and advertising adjusted EBITDA between $970 million and $990 million.
Keeping that margin strong, too.
Yep, projecting an 81% adjusted EBITDA margin for advertising. So continued strength and profitability on that side. The lack of apps guidance really underscores the pivot.
Okay, clear focus on advertising going forward. Let's bring in that analyst view now. What did Smart Karma make of all this? Did the results beat their expectations?
Oh, yeah, significantly. Smart Karma noted the EPS, earnings per share, was $1.67, which beat the $1.46 estimate. Revenue of $1.48 billion was well above the $1.38 billion forecast.
So better than expected on the top line.
And bottom line, too. Adjusted EBITDA came in at $1.01 billion. Much higher than the $871 million expected. Net income also beat projections.
So clean sweep then. Beat expectations across the board, which again makes that post-market stock dip a bit puzzling.
Exactly. It fell about 4.4% after hours, closing at $290. Smart Karma does point out that, overall sentiment is still very positive, lots of buy ratings.
Right.
But that immediate dip, well, as we can guess, the timing of the app's business sale announcement could be a factor. Even if advertising is flying, selling off a whole segment, even a declining one, can create some uncertainty.
Yeah, the market might just need time to digest that strategic shift, even if it makes sense long term.
Precisely. Market reactions aren't always purely logical in the short term. There are lots of factors at play.
Did Smart Karma highlight anything else specific, like why AppLovin is doing so well?
They definitely pointed to AXON, that AI engine. They see it as absolutely crucial for driving the revenue and EBITDA growth. Really good at, marketing automation, making ads more effective.
So the tech is key.
Very much so. And their own smart scores, which look at different factors, they rate AppLovin highly for growth, a score of 5, and momentum, a score of 4. So despite the dip, the underlying view seems to be strong long-term potential.
Okay, so analysts see the tech working, the growth outlook is good, even with that immediate stock reaction. Let's try and wrap this up. What are the sort of key takeaways for you from digging into these Q1 results?
Well, number one, the advertising business is just incredibly strong. Huge growth, amazing profitability, driven by that AXON tech.
Right.
Number two, the apps business was declining, and now they're strategically exiting it, selling it off to focus entirely on advertising. That's a major pivot.
A clear strategic choice.
Yep. Number three, they beat analyst expectations pretty much everywhere, yet the stock dipped post-earnings, likely related at least partly to that app sale announcement. And finally, despite that dip, the analysts, like Smart Karma, seem to remain quite positive about the company's underlying strengths and its long-term prospects, especially around that core advertising platform.
So, a company hitting on cylinders in its main business, making a big strategic change, and the market maybe just taking a moment to figure it all out.
That sounds about right.
Which leads us nicely to a final thought for you, the listener. Given this big move selling the gaming apps to really double down on the advertising platform, how do you think this might fundamentally change AppLovin's future? Its growth path, its position against competitors? It's definitely something to watch.
Absolutely. A story still unfolding.
And if you want to dig even deeper into the details, AppLovin's investor relations site is the place to go. Thanks for joining us for this deep dive.